All right, so what I'm going to do is I'm going to call a mortgage company, so a loan officer, right? Because it's typically where you guys are getting your advice. So I'm going to call a mortgage loan officer and ask for a home equity line of credit. Now, no mortgage companies, I won't say no, very few mortgage companies actually offer a home equity line of credit. Those are bank products, not mortgage products. So I'll probably get met with some resistance off the front end and just say, oh, I'm sorry, we don't do that. Let me give you a phone number to somebody who does. But then I'm going to press them and say, well, since I got you on the phone and you're a mortgage expert, let me get your advice. Here's what I've been taught is to replace my mortgage with a home equity line of credit and not have a mortgage. So the antithesis of what they're selling, right? So I anticipate them being very defensive and coming back and saying, no, absolutely not. It's variable rate, you know, if your payments could skyrocket and, you know, discipline this and all that, you should be on a mortgage, and a mortgage is the most efficient way to finance real estate. So that's what I anticipate. So I'm going to kind of bait them through this and kind of see what their answers are, and I'll actually debate them. So I'm hoping that this turns into a debate that I'm always going to win because it's math. Let's face it, 2 + 2 always equals 4. So I'm hoping this turns into a debate, but let's just see what happens.
So you're looking to refinance?
Yeah, I've got roughly 300 is what I owe on it, and the value's about 390, and I'm wanting to convert the mortgage to a HELOC.
Oh, the whole thing to a HELOC. Okay.
Yeah.
That we don't actually do equity lines at either.
Okay.
But,
and here's what I'm trying to do, and since you're a mortgage professional, maybe you can help me with this and make sure I'm going down the right path. I'm wanting to take that $300,000 and convert it to an equity line, because what I've just been looking for a more efficient way to pay it off. And so far, what I've been taught, or what I've been studying, is that a mortgage is the least efficient, most expensive way to finance real estate. So what I was told was to convert my mortgage to a home equity line of credit, the whole thing, and then start treating it like a checking account, and I would pay it off much faster than a mortgage. Does that sound about right to you?
It does not, only in the sense that the repayment amount on an equity line is, when you get into a loan amount that high, is going to be way higher than a mortgage would be. So, for example, if you took a $300,000 equity line, you pay back, even though the APR is it's going to be higher than a rate anyway. APR would be about 5.99 on an equity line right now. And
well, what I've been quoted so far is 2.24.
Yeah. 2.24.
Uh-huh. So my payment on that $300,000 would actually be less than $600. Now that's my payment though, but I want to treat it like a checking account, is what I've been taught. I mean, based on this calculation, I'm going from 28 years on my mortgage to just under 5 years.
Okay.
To get the whole thing paid off, and I'm not really doing anything different. Instead of
$600 a month, how much would you be putting towards it to get the
all of my income?
Oh, all of your income. Okay.
Yeah. So what I've been taught is to use the HELOC, to abandon my checking account, and to use my HELOC like a checking account. So all of my income goes into it, and I pay my bills out of it, and then my cash flow positivity that's left over is reducing the average daily principal balance.
It's a solid plan. I got to be honest. Yeah, I think that's a very good plan, especially with the interest-only variable. Even if it climbs on you and you're putting everything into it, you are going to be paying off a ton more principal than you would on a
mortgage, right?
Way more interest on that.
Now, when you say variable and it could climb, and I'm not a student of this, what has interest rates done on these types of products in, say, the last 10 years?
In the last 10 years? Well, 10 years ago would have put us before the crash, so that's where things were, really good, but almost on a false surface. That's why things did crash. I'd say from 2008 on is a better measuring stick, and that's where they've always remained at around 4% on a fixed open-end balloon note, because they're all balloon notes after 10 years.
Well, equity lines?
Yes.
Okay.
They are based on a balloon note schedule. Yep.
So far, because I've been calling banks just like I'm calling you to try to get some information. Yep. Most of them are like a 10-year draw period. And after the 10-year, if I have a balance, they recast it as a 20-year mortgage. So they close it in, but it's not a balloon.
Some of them do that, yeah. Some of them do that. Yep.
Gotcha.
And then some of them actually want a balloon payment, or they'll give you the option at that time just to extend it.
Right, but the variable is what scares me. So I'm just trying to see what the last 5 or since 2008, what have interest rates on these products done? Not necessarily the number, but have they gone up or down?
They've gone up only 2%. So it was about 4% forever until the last year, when things started getting a lot more stable in the economy itself, and the Fed has danced with raising the borrowing rate on banks. So we were at 3.99 basically forever on a repayment APR, on a fixed.
Yeah, I'm talking about variable. Now,
yeah. On the variable, it's a couple points lower than that. Like you said, it's around the low 2s, and then instead of 3.99, about a 1.5 to 0.75 lower than that.
well, all these are based on prime, though, right, or something to that effect? Okay.
Prime plus.
Right. Well, yeah.
Prime.
So prime. So if they're all based on that index of prime, what has prime done in the last since 2008?
Nothing.
Nothing.
Nothing. Been zero.
Gotcha. Okay.
It's been zero.
All right. So it's pretty stable then.
Starting next month is when the Fed is going to raise that prime rate from 0 to finally something above 0.
Mm-hmm.
Which is what's going to raise rates across
They raised
the
it
board,
last
but
year
very,
a
very
1/4%,
gradually.
and they're about to
Not gonna
raise it
spike
again in
by
December,
any
another
means.
1/4%.
Today's
He doesn't
spike
even know that.
because
He's
of
in
the
mortgages.
election.
So you like this plan?
I think it's very ingenious. Yeah, I mean, you seem to know every question you're asking. You're asking the right questions. You have clearly researched this, and if your plan is to dump that much principal reduction into it as you go along quickly, then that balloon schedule won't affect you, and you can always just convert the remainder into a 20-year, which would be nothing in terms of interest.
Right.
You can still keep throwing all that money into it.
Well, that says a lot coming from a mortgage guy. I appreciate your honesty and candor. I mean, if a mortgage guy is telling me to do a HELOC that you don't offer, that says a lot about your integrity.
Yeah, I appreciate that.
Maybe you should convert your mortgage to a HELOC.
My wife wants something fixed, so I follow what she tells me, even though I do this for a living.
My wife wants a paid-off house. I greatly appreciate your advice. I think I'm going to move forward with this.
Okay.
Thank you, sir.
Do you want me? You already have your.
Well, I got Sabrina Allen at Legacy Federal Credit Union, so I'm going to give her a shout. I can look her up and give her a shout and see what kind of terms they can offer me.
Yeah, tell her that I recommended her.
Okay, and the name again was?
Daniel McNaught.
Daniel McNaught. I appreciate it, Daniel. Take care. God bless. All right, gang. So what you just listened to was a loan officer. I won't tell you what the company is, and obviously I'm not going to tell you who the loan officer is, but I'll tell you this about the company. They're one of the largest mortgage companies in the country, and definitely one of the fastest growing mortgage companies in the country. And obviously what you just heard from the expert himself was, you could tell the light bulb went off in his head when here I am, the average consumer, saying, here's what I've been taught. And I didn't give anything very specific, any advanced strategies, just a very broad overview. And you heard it directly from him, that's ingenious. And he's got a HELOC, but in second lien position. And he recommends that this is what I do. He's like, you know what, that's a pretty solid plan. So I guess you got to ask yourself this question, is if the experts don't want it, then why would you want it? And I hope you caught the last couple comments that he made. My wife wants a fixed rate. I get that. Everybody likes to sleep better at night, but do you sleep better at night by having a fixed rate with a balance, or do you sleep better at night having a variable rate with no balance and it's paid off? Because we don't go to the grocery store and buy things with an interest rate. We have to use real money. So by paying your home off as fast as possible, you're going to have real money in your pocket. So don't let an interest rate or closing costs or fixed or variable distract you from what the real goal is. And you also heard him admit that even if the rate's variable, because I'm using it as a checking account and reducing the principal, the interest is offset. It doesn't matter. And again, that's coming from, I hate to call it the enemy, but the antithesis of what we teach is a mortgage professional. So the mortgage professional is telling you that you should not get a mortgage. You're welcome. Take care. God bless.